Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. And I want to thank everyone for attending today. We know it's the middle of the summer. There's a lot of places you could be, probably would rather be than sitting inside and watching a market update, but we're certainly glad you joined us today. And, as usual, we have a lot to talk about. The last week has been pretty crazy in terms of some of the moves we've seen over in the bond market. And the bond market's important because the bond market has ultimately dictated a lot of the cross-asset correlations within the equity market, which has had an impact ultimately on client portfolios. Secondly, we'll go over COVID. And certainly COVID has been something that has driven the bond market, which has then driven the equity market. So we're going to go over all of those things today. And I'm just going to go ahead and share my screen like I usually do. And the title of today's presentation is Investing in a Post-COVID World. Now, for those clients that got our email blast back on Thursday, we talked about this potential for a 25% plus rally in our portfolio over the next 2 months. So far, so good in terms of the trajectory of from where we sent that newsletter to where we're at today. Off the bottom from 2 weeks ago, I think we're up about 10%. So we have a lot of work to do, but we're going in the right direction. And I think things are going to accelerate. So we're going to walk through all of that. But the real key here is as fears of the Delta variant start to recede, we are expecting that violent recovery to take place. So, over the last week, we may have very well seen those peak COVID fears. We're going to review that. We saw a big reversal in the 10-year Treasury yield, all the way down to 1.1. Now we're trading around 1.35%. And of course, you've seen a big rebound in a lot of the shares that you own in your portfolios. Cyclicals, the short-term momentum is starting to recover, even though the long-term trend always stayed intact. And that's important. Long-term trends are where we invest. Now, during that long-term trend, as you go upward and to the right, you can have corrections and you can have short-term momentum deteriorate. And that's really what happened over the last 2 months. But the long-term trend stayed intact. And of course, if all this happens, economically sensitive sectors are positioned for an explosive rally here over the next 2 or 3 months. And so we want to hold our ground. That's where we want to stay invested and not get shaken by, the daily news and headlines of the media. And why are we so positive, not just over the short term, but over the long term? This chart says it all. When we look at financials and energy as a percentage of global equities across the world, it has shrunk to around 18%. Back at the peak, it was around 36%. Meanwhile, tech and healthcare have peaked out around 43%. The last time we saw that was back during the dot-com bubble. And of course, we've already seen some big moves this week. We've seen a lot of these tech names roll over, right? Thank God that we didn't, we didn't cave in and buy these names 2 weeks ago, because certainly we would be down a lot more. And then secondly, we've seen a lot of these COVID-related healthcare names really start to sell off. Moderna down around 20% yesterday alone. And so when we look at these big rotations, they happen over decades. And we believe, based on our work, that we're starting a new rotation away from tech and healthcare and toward energy and financials. And some of the charts in the financials look absolutely fantastic. They're breaking out, starting to approach those 52-week highs. We think energy is the next sector to go. And so the portfolios are very well positioned here over the next 2 months. So what needs to happen? Let's go to our playbook that we talked about last week. Economic data needs to continue to improve. We'll go over some of that employment stuff from last Friday. COVID-19 cases need to plateau and begin to decline. We'll walk through how that might start, we might be at the beginnings of that happening. And then of course, the 10-year Treasury yield needs to bottom and accelerate upward and to the right. If we get these three things that happen, our confidence level in terms of that explosive rally is very high. If that doesn't happen, then we sort of sit in this mediocre sideways channel. So what is happening? So let's go away from what could happen to what is happening. This was the cover of Newsweek, ladies and gentlemen, the doomsday variant. When you start to get magazine covers that are very bombastic like this, we're usually near the peak of that story. And what we also saw was when we look at those IHME surveys, we look at the work that they do. August 14th was that projected date if we look at the model based on how fast the virus spreads, the population, the percentage of the population vaccinated versus not vaccinated. Even unvaccinated countries like India and Indonesia saw that 45 to 50-day window. Based on that 45 to 50-day window, August 14th. Then we see the news from the White House that the U.S. has started to see some leveling off in COVID-19 infections in states seeing a surge. Where did you hear that first? We talked about this a week or two ago ahead of the White House in states like Florida and Missouri and Oklahoma and Arkansas. These first states that saw the surge are now starting to see a plateau, and in Missouri, a decline. Of course, then we see the so-called work from home or the COVID stocks have really started to sharply sell off. The one stock we did not include in here was Moderna and BioNTech, which are at the center of the vaccine universe. They obviously went parabolic up almost 100% in the month of July. Wish we were there. But now I no longer wish we were there. They were down 20% yesterday. And so we think that's that bubble unwinding, and that money ultimately flows its way over into the cyclical trade, which is where we're at right now. Employment accelerating. 943,000 jobs were added in the month of July. The market was expecting 870,000. This is a huge number. This does not happen during periods of decelerating growth. We do not see any evidence that the COVID Delta variant has materially impacted growth, despite what Jim Cramer and some of those bombastic talking heads on CNBC are talking about on a daily basis. We just don't see it. We just don't see it in the data. This is the data, 943,000. Continuing jobless claims. Remember, this is updated weekly, so we just got an update today. No impact. Continuing to see those jobless claims decline. Unemployment rate back to 5.4%. Americans want to shop. Americans want to work. We're over the shutdowns. Now it's a question of vaccinations. And that's really the difference between this cycle versus the first three cycles, which were a question of shutdown or no shutdown. This is a question of vaccinate or don't vaccinate, mandate the vaccinations or don't mandate. We're not going to get into that political conversation here, but that's the difference in terms of the economic impact this time around. And then, so we have the economy on fire. We have signs that the virus is beginning to plateau and start to decline. What are bond yields doing? Interesting enough, bond yields, the 10-year yield, sniffed this out last week. A double bottom at that 1.126 level, literally 1.126%, and started to accelerate to the upside toward 1.35%. Just as important, that the 210 yield curve, in other words, that epitomis yield curve that we all hear Wall Street talking about, has started to re-steepen. This is important because the Fed controls the 2-year. It doesn't control the 10-year. The 10-year is a vote of growth, right? If the 10-year goes up, the market thinks we're going to have higher nominal growth. If it goes down, we get lower nominal growth. When that spread is widening, it means that the 2-year is staying relatively anchored while the 2-year or the 10-year is floating up. So when you get that widening 2-year 210 curve, that's good for the banks, because A, they borrow short and lend long. 2, that's good for energy. 3, the industrials, and of course, material stocks, because all of it is a function of economic growth. And we see that in the stock action. We see the banks responding in force. Now, this is very key, ladies and gentlemen. We know the timing of the transition in April and in May was not particularly great because we made that transition just as the COVID Delta variant hit the United States. We can't help that. But what we can help is to pay attention to trend and short-term momentum. And here's what we saw. Very strong long-term momentum for the banks, the energy stocks, the industrial stocks, materials, etc. We know that's a fact. So when we do get corrections, we have to say, is this a correction within a healthy long-term trend, Or is this a correction within a deteriorating long-term trend? And what we really saw was, yes, the percentage of stocks at 20-day highs started to decline, but we stayed within this positive long-term trend model. And it's not just looking at a chart, it's looking at breadth, it's looking at earnings, it's looking at all the quantitative factors that we look at within these stocks and sectors. And then what's happened more recently is the one thing that has been missing, the short-term momentum. So certainly if we look at May and June and July, we've seen that short-term momentum has led to a sell-off as it deteriorated. We've now got that back. Short-term momentum has accelerated. The percentage of stocks at 20-day highs within the financials are accelerating upward and to the right. And that's something we want to see. Then, of course, this is the most important chart, ladies and gentlemen. If there's one chart today to pay attention to, is this one. Cyclical sector ETF flows, the rolling 65-day sum is all the way back to its 5th percentile. When it gets this extreme, doesn't matter which sector it is, whether it's cyclicals or non-cyclicals, financials, tech, whatever it is. When it gets this extreme, you buy it. When it gets this frothy, you sell it. And what we see here is that bonds are on the opposite end, 95th percentile. So what do we want to do? Just looking at this chart, knowing nothing else, we want to sell bonds and we want to buy cyclical stocks. And that's how the portfolio is positioned right now. The other crazy thing, of course, is that we've talked about how the price of oil has done well, but the energy stocks haven't. And we're now seeing that play out in the correlations. Energy stocks have had a 92% correlation to the 10-year treasury yield over the past 10 weeks versus only a 34% correlation to the oil price. So oil prices are still at $70 a barrel, and the 10-year treasury yield, as we can see here on the top chart, is breaking outward and upward and to the right. What do we think the energy stocks will do with a 92% correlation to the 10-year treasury yield? What do we think the oil service stocks will do? Well, they both have double bottomed just as the 10-year treasury yield has bottomed, and we now think they will break out upward and to the right just as the 10-year treasury yield has. We pay attention to data, not emotion, not fear. And then let's talk about crypto real quick. Over the last couple of days, now one thing we want to do better, ladies and gentlemen, is we want to be a little bit more transparent when we're doing these trades and talk about them on the weekly update. So over the last couple of days, we have built a small 5% exposure into Ethereum and into a company called Coinbase. Because we are a stock-based strategy, it's very difficult for us to take direct exposure into the actual crypto coins that we're positive on, but we can do that through closed-end funds such as the Ethereum closed-end fund, or through crypto companies that trade on a public exchange such as Coinbase. Now, we're not buying this for the next daily return or the next week. This is what we're seeing now is after the big crash in Ethereum and Bitcoin in the spring. If you remember, we owned Ethereum. We got out near the top. We then crashed 40 to 50%. We're now buying it back. And we think that the new EIP 1559 protocol is a big, big deal. It basically turns Ethereum from an inflationary asset, in other words, an unlimited amount of tokens can be issued, to a deflationary asset, because we're moving toward a proof of stake model where Ethereum coins are actually burned off. And so we can see that total supply has already started to flatten out here for Ethereum. What happens when supply goes down and demand's up? Prices go up. Now, nothing's guaranteed, but we really like A, the Ethereum ecosystem, and B, we love these new rules and what they mean for the overall supply-demand dynamic within the overall ecosystem. So the real question here is Ether transitioning from an inflationary asset to a deflationary one? And we believe the answer to that is yes. In other words, it should start to price out more like Bitcoin in the future because Bitcoin has a cap on supply. That's a very important development within the Ethereum space. And last but certainly not least, we've shown this chart a million times, but where will dollars flow? This is technology today after a 500, 600% return. And this is energy, which has been negative over the last decade. Ultimately, where's the upside? Where's the downside? You, the client, decide. Just looking at a picture says 1,000 words in our opinion. So overall, as interest rates turn upward, we want to be invested in assets that benefit from a healthy and improving economy. So we go back to our playbook. Are COVID infections showing signs of a peak? Yes, they are. We'll continue to monitor them. Have interest rates started to bottom? 100% yes. We've gone from 1.1 to 1.35. That's a big move in the bond world. And then lastly, is the economy holding up after a month of fear mongering by the media? Absolutely. Job creation is accelerating. Consumer spending is accelerating. Jobless claims continue to fall. So all of these conditions are in place for an explosive rally over the next 2 to 3 months. If anyone has any questions whatsoever, please give our offices a call at 888-543-3776, or you can or please reach out to your advisor as well. And have an absolutely wonderful weekend. Have a great summer if I don't speak to you before the fall. And thank you for all of your business.